Good afternoon, everyone. And thank you for your patience. You came a long way to get here, and this is the last session of the day. And we have an agenda of tax reform proposals, particularly that is relevant for international tax, and those who are engaged in providing service to foreign invested companies or Korean investors, investing outside of Korea, cross-border transactions. You are at the right place. Let me introduce the four most distinguished panelists that will be presenting today. So next to me, to my left, Soyoun Lee. She is a director of international tax at PwC PricewaterhouseCoopers, and she's been in international tax for 13 years and exclusively international tax, nothing but international tax. And she will be presenting the inbound related international tax reform proposals today. And next to Soyoun is Hyejung Byun, a person in the middle. 그냥 거기 킵해주세요. And she is a professor at University of Seoul Law School, and also the Graduate School of Tax. And right now she is in leave of absence from the school, and she is a tax advocacy at the National Tax Service headquarters in Sejong City. And she is the most suitable person to present this topic, which is taxpayer-friendly tax proposals. Okay, so next to Hyejung is Maria Chang. She is a foreign tax attorney. 우리 저 끝에서 두 번째 좀 부탁드릴게요. 네. 그리고 계속 거기 계셔주세요. So she is a foreign attorney at BKL, 태평양 백김리 law firm, and she's been with the firm since 2009. But she started her career in the tax field at PwC in 2006. And she is one of the most notable person in the tax community. And she will be presenting the complex topic in the international tax, which is financial industry related, cross-border transaction related, reform proposals. And then lastly, we have Sim Seo, most experienced in this field. She's been in this field for more than 30 years now. She started her career in the US. And then she came to Korea, and then she worked for various law firms and also for GE, a private practice as well. And she's most suitable to represent this topic, which is BEPS related topic. So, we'll go from me to my left, and then we'll just, make the presentation without further ado. So let me pass this thing to Soyoun, and she will be presenting for the inbound, taxation-related reform proposals.
Yeah, thank you, Sun-young, and good afternoon, everyone. Thank you for taking the time to attend this conference, and I'm very pleased to have an opportunity to present this to you today. So in this session, we're going to run through the key tax law changes that were announced in July this year by the government, and if approved by the National Assembly later this year, will generally become effective from 1st January next year. So let's now turn our attention to some of the key changes to inbound international tax-related provisions that could impact on global companies doing business in Korea. The first proposal we wanted to highlight is increased research and development and facility investment tax credits. These changes are aimed to encouraging investment in so-called national strategic technologies, considered important to the future growth of the national economy. So what is being proposed? Well, under existing law, tax credits are available for qualifying R&D expenditure and investments made to improve facilities. At present, these tax credits are available under a two-tier system. whereby basic credit rates generally apply to qualifying investments, and higher enhanced credit rates are available for R&D expenditure and investments in facilities designed to promote the commercialization of new growth engine or core technology. For example, facilities for the manufacturing of new drugs for which patents are obtained by a company based on clinical trials, to give just one example. And we will take a look on the next slide what these higher rates are. The government is now proposing to add an additional tier to the existing system, so it becomes a 3-tier structure with even higher tax credit rates available for investments in technologies that are regarded as national strategic technologies in respect of semiconductor, batteries, and vaccines. And so if you're working at the company that are operating any of these sectors, then higher and more enhanced tax credit rates may be available. So what will be these higher credit rates? Let's see the next slide, which is this one. Yes. Well, if we first look at the tax credit rates of qualifying R&D expenditure, there's a proposed 10% increase compared to the existing credit rates. As you can see in the first table in this slide, the rates for a large company is 2% in general, and this can be increased to between 20 to 30% for qualifying investments in new growth technologies. This rate will be increased by 10% so that a large company, for instance, will be able to benefit from credits rates of between 30 to 40% for investments made in technologies that will be designated as national strategic technologies. Even higher credit rates will be available for SMEs. Likewise, for tax credits related to qualifying investments in facilities, there is a proposed increase in tax credit rates. For this expenditure, the increase will be between 3 to 4% for investment in these strategic technologies, depending on the size of the company. So for a large company, for instance, at present, the maximum credit rate is 3% for investment in facilities related to new growth technologies. This will be increased to 6% under the proposals for investment in these national strategic technologies. Again, higher rates will be available for SMEs. One important thing to note in respect of these proposals is the implementation date. The proposed tax credit for national strategic technologies will apply to qualifying R&D expenditure incurred and facility investment made from July 1st this year to December 31st, 2024. So expenditure made in the second half of this year will potentially qualify for these new enhanced credit rates. The second proposal is regarding VAT law changes. Currently, a foreign company supplying electronic services to customers in Korea should comply with a simplified VAT registration and VAT return filing and make VAT payments. Electronic services generally include computer games, applications, audio and video files, software, cloud computing services, etc. Under a proposed documentation requirement, the foreign company will be required to keep transaction details for 5 years, and if requested by the tax authorities, submit such details within 60 days from the date it receives the request. The required transaction details include the type of services, persons receiving the services, transaction values, and numbers of transactions, and the time of supplies. The next change relates to the extension of special tax rates for certain foreign individuals working in Korea. Under existing laws aimed at attracting qualified foreign engineers to Korea, certain qualifying engineers can benefit from an income tax reduction of 50% for a period of up to 5 years. Additional benefits are available for engineers of qualified companies that specialize in certain designated materials, components, or equipments. Now, this benefit was due to expire at the end of this year, so would no longer be effective if it was not extended. Under the proposal, these rules will be extended for 2 further years to apply until the end of 2023. The last proposal I prepared relates to the tax reporting requirements of liaison offices, which will be important for any company that has a liaison office or rep office in Korea. Liaison offices are treated as non-taxable entities in Korea on the basis that the activities they perform are non-essential activities and limited to activities such as information collection or market research. Under current laws, liaison offices generally therefore have no tax reporting requirements and, for instance, do not need to file corporate tax return in Korea. We have in recent years seen that tax authorities pay much closer attention to the activities performed in Korea by overseas groups, and in particular, seeing whether the activities create a taxable presence in Korea known as a permanent establishment. These new proposals are consistent with this trend. Under the proposal, foreign corporations with liaison offices in Korea will be required to submit specified information each year in the status of their liaison office. The information to be submitted is to be determined, but examples suggested by the government include personal details of the representative of the office, an overview of the foreign head office, lists of domestic customers, and details of any other activities performed by the foreign corporation in Korea. Based on this submitted information, it can be expected that the tax authorities will review the position of the office in more detail. If the tax authority is of the view that the activities of the office go beyond non-essential activities, and actually the office is performing an important role such as customer or sales support, the tax authority may challenge the tax position of the office. If a liaison office of a foreign corporation is regarded as performing taxable activities, the liaison office must register as a business, which is subject to tax filing and tax payment requirements, and significant penalties can be imposed for failure to comply. The proposed change will apply from the fiscal years beginning on or after January 1st next year, so it is recommended that liaison offices review the activities being performed in Korea to determine if there is a risk of challenge from the tax authority when these new reporting requirements come into effect. These are all I prepared for today's conference, and I would encourage you to contact me or any other member of PwC Korea tax team if you have any questions or concerns on how the tax law changes can impact your business. Thank you very much.
We'll go on to the next topic to Hyejung Byun, who will introduce a few, not too many, but a few taxpayer-friendly improvements expected for next year.
Hello, everyone. My name is Hyejung Byun. I'm working for the National Tax Service in Korea as the Assistant Commissioner for Taxpayer Advocate. Before then, I was a professor, maybe still professor at the University of Seoul. So maybe if there are any who remember me, maybe you remember me as a professor at the University of Seoul. Today, I'm going to talk about taxpayer-friendly provisions. Maybe it's because of my current position. I thought there might be some related the points with my position, between my position and the taxpayer-friendly provisions. But actually, It is not that much related, but it was a good opportunity for me to think about what is good for taxpayers in some different perspective. My presentation is not that, it will be quite simple, a lot simpler than Soyoun's presentation, but as you know, it does mean the taxpayer-friendly provisions are not, it does not mean it is not important compared to the Soyoun's topics. So the revision that released last July is to enable the Korean economy to prosper and flourish for everyone in the post-COVID era. So the government is proposing a series of measures to help taxpayers experience economy hardship. Among them today, I'd like to explain just some proposed amendments of first, the tax penalties, and the second, small business. Let's see the first slide. As most of you can imagine, when taxpayers go through difficult time in the economy, they often fail to pay taxes. So the government decreased the penalties for late payment. So as you can see, the current provisions states that the tax penalty for non-payment or underpayment of taxes is 0.025% per day of the amount unpaid or underpaid. According to the proposed amendment, the rate would be lowered to somewhere between 0.019% and 0.022%. The rate will be determined at the time the relevant enforcement decree is revised, taking into account the commercial interest rates. In addition, the penalties for minor cases of taxpayer negligence are being waived. For late tax payments worth than less 1.5 million Korean won, late payment penalties are being waived altogether. In comparison, under the current law, the tax penalties are waived when late tax payment worth less than only 1 million Korean won. Let's move on to small business. It is proposed to temporarily extend a loss carryback period to the year before last for small and medium-sized enterprises. So small and medium-sized enterprise can deduct loss arising in 2021 for 2019 as well as 2021. As the last proposed amendment I would like to talk about today, qualified small business entrepreneurs can be waived from late payment penalties for delinquent taxes, in addition to interest penalty relief and the installment payments of the taxes. So in these proposals, I think you can see that the government is making efforts to support taxpayers and improve their experiences. I hope these efforts to reduce taxpayers' burden carry on in any circumstances. during the COVID-19 era and post the COVID-19 era. That concludes my presentation today. Thank you.
For presentation, let me just add a little bit of flavor for Hyejung's actually, the presentation about trying to reduce the burden of the taxpayers. So basically, the government decided to lower the interest rate on the late payment penalty, but at the same time, the penalty for the late submission of international tax transactions, international transactions report that you have to do at the end of the report, at the end of the year. My understanding is that there is a provision that will try to reduce the burden by, maximum 90%, comparing to previous year, which I think it was covered by the previous session at the TP section. So as Hyejung said, the government is trying to sort of improve the taxpayers' right, as well as trying to reduce the burden as well in the midst of COVID economic difficulty. So just to point that out. Okay, so moving on to Maria Chang, about the financial industries, or financial industry related proposals.
Thank you. Before I begin, I was just thinking that I'm quite honored to be on this panel of distinguished women professionals, and I don't think that happens very often. And so I just wanted to thank IFA and the Women of IFA Network Korea, I guess, for this opportunity. And I hope that we can continue to have many more panel sessions full of women professionals, distinguished. And I'm very honored to be here sitting on this panel with each and every one of our panelists and our moderator today. So as was mentioned, I will be discussing the changes that will be coming into place with respect to the refund and the credit mechanisms for the financial institutions, so the investment vehicles that invest outbound from Korea to offshore jurisdictions and have foreign taxes. So under the current regime, the qualified investment vehicles that are eligible for a tax credit or refund can apply for up to 14% deduction or as a credit or a refund on their foreign taxes paid. So the types of qualified investment vehicles that apply are investment trusts, companies, SPCs, investment limited liability companies, investment liability partnerships, investment trusts, REITs, asset management companies dealing with real estate, and then undisclosed investment associations. And all of these investment vehicles are types of vehicles that are regulated under the Financial Investment Services and Capital Markets Act of Korea. And these distinctions are important, I think, for this mechanism because the treatment for investment trusts and company type vehicles are different. So for trust type vehicles, these are non-taxable entities for Korean tax purposes, and so they do not bear corporate income tax liability. This means that a foreign tax credit to offset their corporate income tax liability doesn't exist. So even under this current mechanism, they are required to file a refund of up to 14% on their foreign taxes paid. When they are distributing that income onwards to the investors, there's an obligation on these investment trusts to withhold up to 14%, and including local tax, it's 15.4% on the investment the income that is distributed up to the investors, and that is regardless of whether the investors are corporate investors or individual investors. There is an exception for these investment trusts, and that the withholding obligation does not apply to securities companies and insurance companies. And so securities companies and insurance companies are not subject to withholding even if they do invest outbound through investment trusts. And then company type vehicles are a little bit different because they do bear corporate income tax liability in Korea. And so they are able to offset their foreign taxes paid from their corporate income tax liability. And so from that perspective, they are granted first a tax credit on their corporate income tax liability, and any amount in excess of that may be eligible for a refund. I think just from a practical perspective, even these corporate type vehicles don't necessarily end up with corporate income tax liability, primarily because they do make use of the dividend paid deduction mechanism. And so by doing so, they have they effectively eliminate corporate income tax in Korea. And so there is little to none CIT for them to offset foreign taxes with. And so from a practical perspective, what we generally see is that even with respect to corporate vehicles, they do rely on the refund mechanism to offset their tax burden in Korea. Moving to the income distribution for corporate vehicles, the treatment is a little bit different for corporate investors and individual investors, in that for corporate investors that do invest through the corporate type vehicles, they are not subject to withholding. Individual investors, however, are subject to withholding at the rate of 14% or 15.4%, including local surtax. And so you'll see that there's a two-tiered system that applies. And so there's a refund mechanism at the level of the trust or the corporate vehicle. And then there's a withholding requirement for the investors. The amendment revises this two-tiered system, and I think the intent was to try to streamline this to the extent it can. So for individual investors or investment by corporate investors into investment trusts, foreign taxes paid will be deducted from their tax withholdings at the time of distribution of the income to the investors. For corporate investors that are not subject to withholding because they have invested through corporate company type vehicles, their foreign taxes paid will be claimed as tax credits at the time of filing their corporate income tax returns. And so the intent of this mechanism is not necessarily to change the tax impact. It's intended to relieve administrative burden for the asset managers that have had to, under the current regime, had to file refunds and then to withhold once again at the time of income distribution. I guess what's interesting about the amendment is that it's silent on the treatment of the income distributions to securities companies and insurance companies that have invested through investment trusts. And so it is unclear how those structures will have to deal with their foreign tax payments. I guess the reasonable interpretation of that would be to allow them also to benefit from the foreign tax credit system as well. Excuse me. This new mechanism will come into place for distributions from January 1st, 2023 onwards. There are other minor changes that are relevant to the financial industry, and most of them pertain to the tax law changes that are made to align the tax law to the changes that were made earlier this year to the Financial Investment Services and Capital Markets Act. So just by way of background, the Financial Investment Services and Capital Markets Act made a slew of changes to their private fund regulations. And so PEFs, which are management participation funds under the former regime, have now been, I guess, recharacterized as institutional private funds. Hedge funds, which were the private funds with institutional investors, are now referred to as general private funds. And so this big change of the fund regulation under the Financial Investment Services and Capital Markets Act has required the tax law to align its wording or its, I guess, classification of the funds to institutional private funds and general private funds. And so the language under the current tax law that refers to PEFs will now refer to them as institutional private funds and to hedge funds as general private funds. And the main provisions that affect these changes are the income deduction provisions for SBCs and the foreign tax credit mechanism for investment companies, and then the income classification for foreign pension fund investments. So those are the main changes for the financial industry that I had today. Thank you.
Okay, thank you. If we have some time left at the end of, Simsa's presentation, can you go back to this slide, and maybe Maria, can you go into the details of, how it is different between institutional private funds and general private funds in terms of tax treatment, if we have time left? Okay.
I think so. We should have plenty of time.
Right, but then I want to go to Saw and then give Maria a little time to think
Okay.
about it. So let's move on to, Sim, and let's do BEPS related.
Okay.
Okay.
So, sorry. So, as the last speaker on the last panel of the day, I had promised to keep this short and simple. And fortunately, the topic that I will be addressing is relatively straightforward. But because the proposed amendments to the non-deductibility of excess interest expense provision are mostly clarifications of the current rule, I will first go over what the current rules are so that the amendments can be understood in context. As you know, using related party interest payments to reduce taxable income is one very easy method that multinational groups use to employ in tax planning, especially where the interest income is paid to a recipient in a low tax jurisdiction. Korea took the core recommendation of BEPS Action 4, which addresses the base erosion and profit shifting risks arising from the excess interest deductions, and adopted a relatively straightforward provision that came into effect in 2019. And basically, the Korean rule provides that net interest expense that is in excess of 30% of adjusted taxable earnings is going to be disallowed. It should be noted that the disallowance rule is applicable only to related party interest and applies on the net amount. So for purposes of applying the disallowance rule, net interest expense is calculated by subtracting the total amount of interest income that the Korean company receives from its foreign-related companies, foreign-related borrowers, and subtract that from the total amount of interest expense that the Korean company pays to related party lenders from abroad. The adjusted taxable earnings is defined as taxable income of the Korean company before taking into account the deduction for interest, depreciation, and amortization. It's commonly referred to as EBITDA or EBITDA. In Korea, the calculation of the excess interest expense is done on a separate entity basis. As you may know, consolidation is fairly rare in Korea for income tax purposes. But even if the Korean entity were part of a consolidated group, the calculation of the disallowed interest amount would be done on a standalone basis. Also, the calculation for the disallowance amount is done on an annual basis, and there is no carryover of any excess interest that is disallowed. So any disallowance of interest expense is going to be permanently lost. In addition, if you have excess capacity, in other words, even if the net interest expense is less than the 30% of adjusted taxable earnings, that excess capacity will not be eligible to be carried over for other years. So that any excess capacity that is unused in a particular year is going to be also permanently unused. As you can see, from a taxpayer perspective, the inability to carry over the net interest expense or the disallowed interest expense to other years can be harsh, since it doesn't take into account the volatility in annual earnings that a company may experience. In addition, it's especially harsh to startups that have limited or no EBITDA in the early years. Finally, the current provision on the non-deductibility of excess interest expense has an ordering rule that if the Korean company has excess interest that is disallowed, and the Korean company has multiple intercompany loans from foreign lenders, then the interest that is going to be disallowed is attributed first to the loan, intercompany loan with the highest interest rate. This is actually significant because of the potential secondary adjustment tax consequences which may arise. What I mean by that is, contrary to the recommendation in BEPS Action 4, for Korean tax purposes, any interest that is disallowed under the disallowance rule is going to be recharacterized as other income. In Korea, other income paid to foreign persons are subject to a withholding tax, unless there's a tax treaty that specifically exempts other income from withholding tax. So, if the interest recipient originally was not subject to Korean withholding tax because of an interest provision in a tax treaty, if that interest is later recharacterized as other income, then the interest recipient may now be subject to withholding tax on the recharacterized other income unless there is a treaty provision that would exempt it. So that is the current state of affairs. The proposed amendments provides additional ordering rules for the attribution of disallowed interest. First, in cases where the Korean company has multiple intercompany loans that have the same interest rate, the disallowed interest paid will be attributed first to the intercompany loan that is the most recent in date. Further, in the case where the Korean company has multiple intercompany loans that all have the same origination date and the same interest rate, the disallowed interest will be sort of allocated proportionally amongst all the intercompany loans. Again, to the extent that the other income is not covered by a treaty provision, such recharacterization of the disallowed interest may result in additional withholding tax consequences to the various recipients. Finally, the proposed amendment clarifies that where the adjusted taxable income of the Korean company is negative, that adjusted taxable income will be treated as zero for purposes of calculating the excess interest. The proposed amendments are to be effective for fiscal years beginning on or after January 1st, 2022. And so that is basically my presentation. Thank you.
Thank you. Can we go back to the slide that Maria presented at the last, so 우리 저 끝에서 두 번째 분이, so yeah, maybe we can have Maria explain a little further about the amendment.
So I think you were referring to this slide. Is that correct? Yeah. So I guess what I was trying to convey with this slide was not necessarily to go into in depth about the funds, I guess, taxation, which I think Kim Byun-sa님 is much more of an expert on, and so perhaps she can elaborate on areas that I may not be an expert at. But for purposes of this slide, it was just to convey that the Financial Industry Services, Investment Services and Capital Markets Act did do an overhaul, and now PEFs are referred to as institutional private funds, and hedge funds are referred to as general private funds. Now, based on my experience with PEFs, private equities are generally considered as corporate investors, and so they do are company type vehicles, but they can choose to be pass-throughs, in which case the income passes through to the individual investors, and they are the ones that have to file corporate income taxes. There are certain instances where they are classified as pass-throughs without actually filing, and so pension fund types investments are eligible for pass-through treatment. Limited partners within the PEFs have an obligation to file their own income taxes as well. Hedge funds, I do not have much experience on, and so maybe that is an area that Kim Byun-Sunny could elaborate on, because our practice generally focuses more on PEFs and trust-type vehicles through which investments are made outbound.
Which is true for me as well. So I was trying to get a little bit of learning out of this slide, but I don't have much experience in hedge funds either. But if I find out, I will let you know. I have about 10 minutes left. So if any of you have questions, I know you can send a message to us. If you do, please send us a message. In the meantime, I forgot to mention that this session is sponsored by WIN division of the IFA, meaning Women's Initiative Network. So Maria reminded me when she said that it's all female professionals here, and that is because we all are part of WIN network in the IFA, and it's amazing to see, how many women professionals have increased in this field, because when I first started, it was basically me, Sim, and An Soo-jung at Yulchon. That was 3 of us, and that was it, right? But now I see many more women professionals these days, and I think it's really, really good, and I feel very, very amazed at how the field has changed. 혹시 있나요? 없습니까? So we don't have any questions from you. I think that will just wrap up our session, and I think this will be the last session. So I guess I'm wrapping up for the day. So thank you very much for participating, and thank you very much for listening so well. And we look forward to another session tomorrow, which will be conducted in Korean language. So look forward to meeting you all there. Okay, thank you.